If you're catching this video, 9 out of 10 times you're a credit card enthusiast, or you at least have found value in using credit cards on a regular basis to advance your personal finances. You think American Express, Navy Federal, Chase Bank, many others that we are big fans of on this channel, these same card issuers have hit the marketplace, pounding the pavement, trying to figure out how they can be pickier and more selective on who they're issuing these cards and other lending products to. And FICO has stepped up to answer this challenge. So this video is going to be covering a data analytics tool that FICO has rolled out some years in the past, but it's going to be more prevalent now than ever with the economic turmoil that we're in and likely heading into. I'm going to be covering my analysis on this, but more importantly, I'm going to give you highlights from a direct interview from an executive inside of FICO who is one of the product developers for this tool, to give you context on what this tool is, how it works, and how it could be affecting your credit card approvals and other lending approvals going forward. Before we get into all of that information, I'd like to give you context on who I am so you know who you're getting this information from. My name is JP. I'm a financial services professional, a banker by trade, 13 plus year veteran in the financial services and banking industry with active mortgage loan originator's license, active FINRA Series 6 investment license, life insurance license, as well as small business certified for the financial institution that I work for. Think banking, cash flow, and lending needs for small businesses. I help consumers from the very inception of their finances all the way out to 6, 7, and 8 figures in net worth, and the same with small businesses in their inception all the way to 6, 7, and 8 figures in revenue. So along with my own personal financial development, I'm actually an expert in the industry with well over 10 years of experience when it comes to banking, lending, etc. So you're getting this information from somebody who has hands-on experience and takes hundreds of applications on credit cards on the consumer and business side on the annual basis. So that having been the case, FICO has stepped up to a major request from lenders to be more risk averse, be more mindful of who they're lending out their credit card and credit products to when economic turmoil is taking place. FICO has stepped up and developed a product that is intended to give a gauge to lenders to give an advanced insight on those who may be more susceptible to economic downturns. This product is called the FICO Resilience Index. This product is designed to analyze your existing FICO information, your credit report information, along with other data to give some kind of an imagery of how you might function or what your outlook could be if you experience economic hardship, your likelihood to repay to these lenders, etc. Before I give you further analysis and my opinion on this product and my analysis, I want to give you a few minutes of highlights from a direct interview shot a few years ago, but under the radar, from an executive at FICO who was part of the development of this financial tool, this data tool, so you can hear it from the horse's mouth. And then I'm going to hop back in and give you my context on what I think about this and how you need to prepare yourself based on what we've heard from this executive and how this product works.
Since we've been doing FICO scores for 30 years, we have the experience of looking at FICO scores after the fact, after the Great Recession, after natural disasters like Hurricane Harvey, and we learned a few things from that. One is that, credit scores still rank order. So the point of a credit score is rank ordering. It's not intended to be a point predictor of risk. It's not 680 means, exactly this default rate. But what happens is as the economy shifts, goes through cycles, that relationship between the default rate and the score will shift over time. So for example, in the Great Recession, it pretty much doubled across the board, delinquency doubled across the board, whether they were high scoring or low scoring. But we still saw that the scores rank ordered, that the people who scored higher perform better than the ones who scored lower, and so forth. So credit managers, especially those who've been through economic cycles, are fully aware of this pattern. So they know that they need to monitor very carefully and really understand what's happening in segments with this particular economic downturn. But, number one, scores still rank order. There will be shifts in the odds to score. And the other thing we've learned from the past economic impacts is that overall scores don't shift quite as much as people expect them to. Right. There will be some where their scores go lower because they were personally impacted. However, as an overall, the scores look at a lot more than just recent delinquency, right? They look at the whole history, they look at balances, they look at how you manage your credit overall. So it's not as much of an impact as people think, and we've seen that from the past.
So how do you sort of factor in the forbearance programs into scores?
Mm-hmm. So in terms of how the forbearance programs, how the score reads the forbearance programs, the score is really looking purely at the status, the delinquency status, and so forth. So if the lender is doing what they're supposed to be doing, right, if they're following, say, the CARES Act and other guidance, if they make an accommodation, they should report it as paid as agreed, right? So they shouldn't report it as delinquent based on what the original, agreement was. It should be based on what the accommodation is. And so that should not impact the FICO score at all. And even if they put in a code that indicates that there's a forbearance, the FICO score doesn't look at that code. Okay. And there's a very good reason why it doesn't look at that code. That code is generally only there during the time of the disaster, right, during the time of the event. And so, if we factor that information in, then at some point that code's going to come off, and then there's going to be this huge, shift in scores if we were to actually, look at that code or interpret that code to mean, this person shouldn't be delinquent even though it says they're delinquent. So it's really important for lenders to actually report the status the way they have agreed in the accommodation.
I'm sure when you were probably putting this together, you had no idea there was a pandemic that was going to hit, and it was going to become a very important piece of information for lenders. So maybe we can start by just talking about the origins of this of the FICO Resilience Index.
Sure. You're right. We had no idea that around the time we were launching this, we would be heading into a pandemic. However, we knew, as every credit risk manager knows, that there will be economic cycles that will continue, ups and downs, that lenders need to manage to. So we've actually been working on various types of solutions related to managing through economic cycles for decades. And so this particular solution, the FICO Resilience Index, came about because credit managers typically, even in a benign economy, they have to factor in the fact that at some point there will be an economic downturn. And so, they actually price that risk in, even when the economy is pretty good. Mm-hmm. So what we've had credit risk managers ask, we know that when the economy turns down, there will be higher risk at every score band, right? Just as was said before, in the Great Recession, it was about double the default rate in every score band. Can you tell me which of the 680s are the ones that are going to go bad? And so we set out to answer exactly that question. We researched, can we tell from, benign economy to a recession, can we tell the type of consumer that would perform very similarly in the two scenarios versus the ones that would perform very differently and be far more sensitive to being in a recession? And that's exactly what the FICO Resilience Index looks at. So what we're seeing is, first of all, the FICO Resilience Index looks at the same underlying data as a FICO score. It looks at the information on the consumer's credit report. It just looks at it differently, and it's designed differently. It's designed to predict a different outcome. It's designed to predict who's likely to be very different in a recession than they are in a benign economy, right? So, which we call sensitive to the economy as opposed to resilient to the financial stress. So it looks at the credit report. It is used in conjunction with a FICO score, right? Because you still need the FICO score to tell you what range of risk it's in.
Yep.
But as you point out, if somebody is 680, there's more than one path to 680. There are different ways that someone can be a 680. And what we see is the ones that are more resilient have more experience with credit. They aren't taking up a lot of new credit. They might have some delinquencies. Delinquencies really doesn't have as much of a play in the resilience index as it does in the FICO score. So it's really about, how one manages credit that tells how resilient they will be in that downturn. So the more sensitive ones will have more newly opened trades, less variety of credit, just because they're just have less experience with credit.
So in a highlight reel, you've essentially heard firsthand how this product works, what it's for, where it's surfaced from, the first real marketplace exposure it's had since COVID. And you should have context on how this can continue to be a major game changer in underwriting going forward. It's already been dispersed in the information that you just heard. Lenders are already pricing in future potential risk of you defaulting on loans. They're already charging you and underwriting you based on the potential risk that somebody's not going to pay them back. This tool is designed to give those lenders greater insight so they have less restriction or unnecessary yielding in their lending capacity during economic downturns. They can also make adjustments when the economy is good to try to buffer for economic downturns. This tool is very advanced and is going to continue to evolve. When you think about playing a credit card game, when you think about many of us that are enthusiasts, one of the unfortunate habits that we have is many of us tend to get a little aggressive based on learning these various insights and data points on institutions when it comes to getting approved. So when we learn a little bit about, what bureaus they pull from, their minimum credit score requirements and other hacks, we tend to try to manipulate that in our favor and get access to way more credit than we normally would have gotten access to just because we've learned a little bit more about the system. As you've heard directly from a FICO executive around this topic, this is one of those traits that would give you a bad resiliency index and could play a role in your approval or pricing in getting approved for credit cards and other lending products. Banks, lenders, other financial institutions, their product is future profit based, to just dub it with a term, essentially stating that their products, they're not selling you a piece of furniture that's a one and done. They're selling and extending a product that they're going to make the most money on down the line. They actually need you to survive as a client. They need you to actually do well as a client well into your life cycle in order for them to really start making a profit. And this is very important to understand. This is what created the desire, the need, the marketplace need for a tool that can analyze the probability of default or those who are going to be likely to continue to be resilient if they face economic hardship. So when you're on your app sprees or, whatever the case may be, whether that be for consumer credit card, point arbitrage, tactics or travel hacking, or that's for, business capital to start, expand and grow your business, you have to be mindful of your credit habits because this information is literally being gathered, it's being analyzed. And despite the fact that you may feel perfectly competent at what you're doing, the system, the AI, the technology, the underwriting is evaluating your behavior and assessing whether or not you're going to be risky in the future. And some of those data points were covered in these highlights. It talks about too many new accounts, being new to credit, overexposed. These are the type of things that these credit card issuers and lenders are going to get direct insight from a collaboration of the credit reporting agency and FICO pooling this information together and spitting out, literally a mathematical equation of sorts on your likelihood of being a risk in the future. So if a bank is looking at you and you may have a decent FICO score now or even a great FICO score, but your behavior right now is calculating out to a poor resiliency if you were to be faced with economic hardship, then you can mess around and potentially experience a denial or again, some kind of excessive pricing that you would not have been exposed to had you just been mindful of your behavior. Because again, financial institutions, banks, credit card issuers, they're looking for long-term success. I talk about this all the time in other videos. Many people get hung up on the cost of credit cards and in different use cases, etc., without understanding that these different costs and these different fees are being tacked on as a behavioral mechanism. It's intended to deter you from functioning with that product in that way. That's why it's so partly, at least, why it's so expensive, because it's probably a high-risk behavior. So banks are looking to buffer from those risks. And if they have to tax you to do it, that's what they're going to do. You have to be mindful going forward. This is 2024, 2025 and beyond. As I've also indicated in this video, there are tailwinds and headwinds suggesting that we are already in and could be heading into economically tumultuous times. We already have economic shakeups roughly every 10 years or so anyway. That is picking up speed now that technology has advanced, money and business activity and economic activity is happening faster than than ever. So now what maybe 10, 12, 15 years before we experience certain economic, shifts and changes is now, as you can see, being reduced down to 5 years, 7 years, sometimes less. We just got through COVID a few years ago, and we're already experiencing the, interest rate policy shifts from the Federal Reserve, for instance, slowing down the economy, starting to increase unemployment. We don't know how the election's going to turn out, etc. There are tons of economic factors domestically and abroad that are affecting how the economy is going to go. And all of that comes back home in the underwriting of your credit card or lending application, because banks are literally gauging these risk levels not only in your behavior, your data, but they're looking at the broader macro level economic picture to determine their lending appetite, to determine how picky they're going to be. I want you guys to each continue to excel, to grow, to win. And I am doing my part in bringing you the data, the information, the insights, the psychology, etc., to help you make smarter decisions as you move forward that may be in your blind spot, but it's something that I'm bringing to you to the forefront to help you mitigate your losses, mitigate your risk. So this FICO tool is already in the marketplace since about 2019, 2020 at least. It's been tested through COVID. It's probably getting broader and broader levels of adoption. And it is important for you to understand I need to control the picture that I present to credit card issuers and lenders as I am applying for these different products. And this is just another one of those things you have to consider when you're going out there shotgunning applications or, hopping from bank to bank, credit card to credit card. You got to be mindful. You can end up presenting yourself totally differently than who you really are as a borrower. So be mindful. I want you to comment down below and let me know if you were already familiar with this product. Have you done any research on it? Where does your financial resiliency index land? I want you to tell me if you actually following this, tool firsthand. Let me know where you are. For me, I actually noticed that I was somewhere in the 30%. I think the last I looked, I was at about 39 out of the 99. So, when as presented in this video, the lower the number, the more favorable you look, the more resilient you come off. So work to be done on my end, but clearly better than the 50% threshold. Let me know where you are. Has this brand new to you? And let me know your thoughts if it is brand new to you. Let me know where you stand with this, or how you plan to adjust your financial plans, your application sprees, etc. Comment down below. To all my pioneers, welcome back. To my new viewers, welcome in. It's always a pleasure to have each and every one of you. I want you to continue to support the channel by commenting, sharing, and subscribing so this channel can continue to support you. I want each of you to stay focused, stay in motion. I'll see y'all soon.